All right. Welcome to the show, everybody. TSP Weekly Podcast. Every week, these two guys talking about the TSP. What do you got for us this week, Jerry?
It is another interesting week, right? We are approaching Santa Claus rally season, and hopefully Friday's reversal was the beginning of that. S-Fund kind of underperformed for the week, but had a really good reversal on Friday. Other than that, all the other stock funds were up for the week. So we should have a pretty good run going into the end of the year. But a lot of this podcast is going to be kind of focused on cycles going into 2026, and there's some things to think about going forward. So we'll take a look at weekly economic highlights, jobs data from October and November, which the Fed did not have before it did its last 25 basis point cut last week. Then we'll take a look at the unemployment rate, which really is kind of driving one of the things. You can add that to the cycles going into 2026, and then the TSP fund direction. So the big news of the week really was the CPI. The annual inflation rate came in at 2.7% in December. It was the lowest since July, and it was below the forecast rate of 3.1%. So analysts thought the inflation rate was going to be 3.1. It came in at 2.7. This is a 10-year chart of the inflation rate. Okay, so everybody remembers back here in 2022 when inflation peaked at 9%. Okay. This is the 2% level. This is the Fed's claimed target, right? They want to keep inflation at 2%. And historically, it kind of oscillates along that 2% line, right? If you go backwards, it's most of the time it's oscillating around that 2% line. And we had this big spike in inflation coming out of COVID. So the Fed started to raise rates. So when inflation comes up, one of the few tools that the Fed has to fight inflation is to raise the Fed funds rate, with the expectation that raising that rate is going to raise long-term rates going forward and push inflation down. So if you've heard in the financial media, the Fed is always behind. It's behind the curve. So the Fed didn't actually start to raise rates until somewhere in here in 2022. And they were raising rates until somewhere in here in 2023. And then they kept rates flat, right, until September of 2024, when they started the most recent rate cutting cycle. So whether or not the Fed has a much of an impact on inflation is kind of arguable, because they were clearly behind the curve. They didn't start, raising rates until here, and inflation at that point was already basically peaking. And then once they started cutting, inflation was already coming down. Since September 24, right about here, let's say, inflation in September, when they started cutting rates, is basically the same as it is now. So you would think that, the Fed's cutting rates, inflation goes down. The concern is that when the Fed starts cutting rates, inflation starts going back up. But that hasn't happened. We also have the worry about tariffs driving inflation up, and that hasn't happened. So it's staying pretty stable. It's not getting down to that 2% level, right? We haven't been down to 2% since, here's the 2% line. We definitely have not been back there since 2021. There is a lot going on in the bond market that's really driving this. The Fed does not have much control over the rates right now, or inflation for that matter. You got New York State Manufacturing Index absolutely collapsed, down 3.9 from 18.7. So two sides of the economy, right? Manufacturing and services. This is another 10-year chart, because I just wanted to give kind of a broader perspective. So when the economy is expanding, when it's above that zero line, the manufacturing side of the economy is expanding. And generally, when manufacturing is expanding, the stock market is going up. Okay. When manufacturing is in contraction, the stock market is generally going down. So you want to see expansion in manufacturing. And maybe we're starting to see that. November wasn't a great month, but we're still putting in higher lows, right? So as long as these higher lows continue, the trend in manufacturing, if we can get up, going in that direction, it'll be really strong going into 2026. If we can keep that upward direction going. We had initial jobless claims decreased by 13,000, right? So 13,000 less people in the prior week applied for unemployment benefits. And it reversed the prior week's upwardly revised 237,000 and was below the forecast. So market forecast was for 225,000 new unemployment claims. It was a modest decline, suggesting labor market conditions remained broadly stable in December. So this is the 1 year chart, and here's December. It's pretty stable, right? It's people, at least on this metric, initial jobless claims. There's not a lot of people. It's not a big spike. It's actually a decline from November. Not a lot of people applying for new unemployment claims, which is a good thing. Government payroll was kind of the big one, the interesting one that we got this week because we hadn't had it, right? We had the government shutdown. So government payrolls in the United States decreased by 5,000 jobs in November. Government payrolls average 18.63 thousand from 1939 until 2025. So what that means is every month, the average gain of government employees was 18,000 jobs. Reached an all-time high of 486,000 in August 2020, record low of minus 918,000 because of COVID in April 2020. So what I thought was kind of interesting is this is the chart, right? So this is the zero line. So if it's above zero, the government is hiring. If it's below zero, the government's losing jobs. With all the talk, well, here's COVID, right? It's a huge outlier. If you went back further in the chart, it's a huge outlier. And it makes sense because that's COVID. And then we had a huge inflow, which is also an outlier, right? After COVID. But what's really interesting is this part right here. With all the Doge stuff, all the government employees, definitely there's a lot of churn in the government. But as the numbers come out, this was October. This was when the numbers came in when everybody took the buyouts that were effective basically at the end of October. And so it's a little bit, well, it's a significant spike down, but it's pretty much the same as what we had following the big increase after COVID in 2020. So it's not as dramatic as I expected it to be on the chart. And it was only 1 month. I mean, November was a little bit negative, but not very much. So if you did the cumulative of these 3-4 months, it's way more government employees losing their jobs than the last couple of months. Even this whole year, which the whole year was all about, government employees losing jobs. So that's not to say that people aren't losing jobs. It's just, it's a very odd chart, I thought. Okay. So the broader, what's called the U6 unemployment rate, it's basically, they call discouraged workers and part-time workers. So basically people that can't get full-time jobs. We've talked, in the last couple of podcasts about how full-time jobs are declining, right? So people are trying to get part-time jobs, and the chart of that is kind of interesting because this is a big spike, right? In the U6 unemployment rate. So it's saying that people are losing full-time jobs and they're trying to supplement it with part-time jobs. So a lot of these numbers kind of conflict. I understand that. But some of these are kind of important. And this is obviously a big spike above the average. So there's definitely some unemployment churn under the surface. If you're looking at it in the financial media, that a lot of companies have laid people off in the last few months. A lot of those people are now looking for part-time jobs because the number of available jobs is way down. So that's a concern of the Fed, that while unemployment rate, until we're going to get to that, but until this week was, low, the number of available jobs was also low, meaning if people get unemployed, there aren't a lot of jobs for them to go to. And so as the unemployment goes up, you get a spike in the U6 unemployment rate. So unemployment rate's going to be a big one. It went up this week from 4.4 to 4.6. Okay. So we have a pretty clear uptrend since the bottom in 2023 in unemployment, right? This is the unemployment rate, so it's not good. We don't want to see high levels of unemployment. So this chart goes back to 1948. The green shaded areas are recessions. Okay. So it's pretty clear, whenever the unemployment rate starts to does a rounded bottom and starts to go up, it generally goes up in a hurry. And when that happens, we're having a recession, right? It's pretty much the same all the way along. The only outlier to that is 2016. We had a recession in 2016, but it was not, we did not have a big unemployment spike in 2016. So a recession is 2 consecutive quarters of negative GDP growth. So in that case, in 2016, which was the only one here going back to 1948, we did not have an uptick in unemployment. Okay, so if you overlay the S&P 500 on that, so now you got the S&P 500, it's a log scale in black, and the unemployment rate is in blue, okay? So what everybody talks about, and we're going to get to here in a second, starting in 1990, let's say, here's a early 1990s recession. You got unemployment rounded and then spikes up, stock market falls, unemployment goes down, stock market goes up. Okay. Rounded bottom in unemployment goes up, we get a recession, stock market goes down. Right. There are times, actually really only one time that you can see really well was 1954. You got unemployment going up and the stock market going up, and we're in a recession. So I'm pointing that out because it defies logic, defies everything. And could we see that in 2026? It's a possibility. It's the only time you really see it on this chart, but it's okay. So if we zoom into the kind of closer term history, right? Here we're going back to 1990. We got what I wanted to point out here is I put a relative strength indicator on the unemployment rate. And so when relative strength gets above 50, that's when unemployment starts to spike, and that's when recession begins. So that happened in 1990. It was the same thing going into the top in 2000. Or sorry, going into the top in the stock market in 2000 was the bottom in unemployment. Same thing in 2007. Same thing in COVID, right? It happened really fast. And we got above that 50 RSI in May 2024. That was the first time that RSI went sideways, basically, along that 50 line, and then it spiked here in the past couple of months. So that uptick in unemployment is potentially pretty important. And if we overlay that with the S&P 500, usually the market is rolling over before unemployment gets above that 50 RSI line. It's starting to roll over first, and we're not seeing that yet. So it's possible that unemployment can continue to rise for a while before the market in the big scheme of things rolls over. But we're getting based on the unemployment as a metric, we're getting closer to a top. Okay, so cycles going into 2026. So we take employment or unemployment as the first one. The second one is the 10-year decennial cycle. So each year that ends in a 0, 1, 2, okay, what this chart does is it goes back and it does the average of all those years going back from 1897 to 2020, right? And then it joins those years together to make that chart. So one of the interesting things of this is the 5-year, right? There were a lot of reasons to think 2025 was going to be a down year for the market, but the cycles would indicate that the 5-year is almost always the strongest year of the 10. And that's what happened, in 2025. It was a huge year. The 6th year tends to be flat to down from the beginning of the year into basically November. And then we have a big rally into the end of the year and into the beginning of year 7. So this is just something to think about for 2026. The cycle indicates that it could be a choppy to down year. Next one is the presidential election year cycle, or the presidential cycle. Okay. So this was from back in 2021, but it doesn't matter. It's going back to 1900. Okay. And it goes through 2020. So it's the same thing. It's each of the 4 years of the presidential cycle. And this is the average of each year. And then you push them together, basically, going back to 1900. So we just finished the first year of this presidential cycle. And this correction was the summer correction that everybody expected. We didn't get that, right? We got the correction earlier in the year, but we didn't get this one in the summer that everybody expected. So this is kind of where we are right now. And this is what the cycle calls for, which is very similar to the 10-year cycle chart that we just looked at. This is the second year of the presidential cycle going into November, when we start to get that big rally going into year 7. Okay, so these two definitely overlap really well. Okay. So when we get out of this, right, November should be more, give or take November, should be a great buying opportunity. But the first half of the year, first 3 quarters of the year could be pretty rough. And then the last one is S&P performance before and after U.S. midterm elections. So this says the largest drawdown. I don't know why they say that. It says the largest drawdown, right? But this is every midterm going back to 1926, right? If you look at this, it's every 4 years going back to 1926. The drawdowns are pretty significant, all right? So the idea here is just to kind of get your mind around going into every midterm election cycle, the market has had a pretty significant pullback in the 12 months before it. So we are just now, right? We get November is the midterm. So we're just now kind of getting into that 12-month range. And, we had minus 41.8% in 1974 and minus 4.4% in 1954. The range it's a pretty big range, but there are definitely years that you have big drawdowns going into the midterms. But again, that tends to be a really good buying opportunity, because when you come out of it on the other end, going into year 7 tends to be really positive. So again, just to point out the first half of the year, to expect some kind of relatively significant pullback. And TSP fund direction. So We talked about this is a weekly chart of the S&P 500. Each one of these green or red ticks is 1 week of price movement, and this is the 20-week moving average line. So the weekly chart is really helpful because once we got back above that 20-week moving average line in November 2023, every time we've come back down to test that line, we found support there. So candlestick charts can be a little bit difficult to understand if you don't know what you're looking at. So August 2024, this week, the market opened on that Monday, or the first trading day, all the way down there. By the end of the week, it closed back above the 20-week moving average line. So for the week, it never closed below that line. So even though most of this candle is below it, by the end of the week, it closed back above it. So we got support at that 20-week moving average line. Until we didn't, right? That was the beginning of that correction that at the beginning of the year, and we bottomed in April. Once we got back above the 20-week moving average line in April, we stayed above it until we tested it back in November, got support there again, and the rally continues on a weekly basis. This is a bullish week, right? We've been hitting up against all-time highs for a few months now. This is definitely a bullish week. There's a lot of bulls that came in when the market was down here at the bottom and pushed price back up. So it's definitely a bullish week for the S&P. Okay, so besides the S&P, the bond market is really the most important thing to watch. We talked about this for a while. We're using the F fund, right? As the F fund is the aggregate bond index, so it's a really good kind of barometer of the overall bond market. This was the top of the F fund in 2021. We had about a 20% decline in the F fund into 2023. But really, since here in 2022, the F fund has oscillated pretty much below that 100 level. Okay, that line is at 100 for the F fund. It got support there, rallied, came down, couldn't hold it, came down, resistance, came down, resistance, right? We got a little bit of an overage here, a little bit here. The F fund is trying to get above that line, but it's the last 2 weeks have been kind of rough, right? If the F fund continues down, that means interest rates are going up because bonds, the price of bonds goes inversely to interest rates. So if the F fund cannot hold support there at 100 and starts going down, interest rates are going up, even though the Fed is in this rate cutting cycle. That's going to be negative for stocks also. If the F fund can hold that line and start moving back up, interest rates will be going down, bond fund, or the F fund will go up, and that'll be positive for stocks. So we're at a pretty critical juncture here in the F fund, and it's definitely going to have an impact on which way the stock funds go. All right.
Okay, guys, if you like what you see, go check out our website, growmytsp.com. If you have any questions, you can send those questions. Best way to put the questions in the comment section wherever you found the video. If you don't have a comment section wherever you found the video, then you can throw an email to support@growmytsp.com, and the support team will get it over to us. A lot of things to keep your eyes on as we go into 2026. Hope everybody is having a good holiday season, and we will see you guys next week.